Hello again. So we're still on topic one, and in one video, I think I'm going to be covering the middle section on financial assets and instruments. This will be just a recap for many of you in the audience. So here's the notes. And let's start off with some basic terminology. But let's start with what we call real assets. There are things like cash currencies, so the notes that you have of British pound or US dollar, etc., etc. That's a real asset. There's lots and lots of derivatives on currencies and exchange rates, but yeah, these are real assets when they're tangible, they're real, you can touch them, like art. There's real art, there's also digital art, which you may or may not regard as actually a real asset nowadays with non-fungible tokens and so forth. Just because they're on a computer doesn't mean to say that there's still not art that sells at Sotheby's, you know. Real estate or property, more generally, the buildings of a company, that's a real asset. And lots of commodities, of course, copper, wheat, oil, and all the different types of commodities. These are real assets. And generally speaking, a financial asset is simply a claim on a real asset. So the most common type is a security. It's very common because it's a claim on a company or a government, usually a large company, because it has to be large, not to just survive off loans. If it actually issues bonds, it has to be a big company. Or a government, of course. And these are more or less secure because equities, the company shares, these don't really have any rights if the company goes bankrupt, but the bonds do, because if a company goes bankrupt, then there's a certain amount of money left, and the senior bondholders will get paid they bought the bond, and there's a face value of a bond that they should get at maturity, and they'll get at least some of that back. And if they manage to get all of it, then the junior bondholders will get something back as well. This is called recovery. Anyway, we're going to talk about that in topic 2, not in this topic in detail. Anyway, they're more or less secure. Bonds are more secure than equities. So as I said, there's two kinds. There's bonds, so corporate bonds are claims on the assets of a company. Government bonds, claims on the assets of a country. But also there are these things called asset-backed securities, which I'll mention here, but also we'll go into much more detail about asset-backed securities in next topic, topic 2. Equities are, as I said, shares on common stock of a company. Stocks and shares, sometimes we sort of use the term interchangeably, but to be nickety-pickety. What a share is what used to be a certificate, now it's, well, it's held electronically, but the stock is the aggregate of all the shares in a company. But you can also talk about the stock of certain types of bonds as well. So it's not just shares and stocks. So if in doubt, use the term share. And then there's these things called exchange traded funds, which I'll mention briefly here. So what are the capital markets? Well, they are the markets for the two types of securities, for bonds and equities. Now, there's always a primary market and a secondary market. The primary market is where it begins life. So a bond is issued, and with the help of an investment bank who underwrite the whole process, basically assure a certain number of bonds will be sold at a certain basic price. Then once they're issued, then they are traded on the secondary markets, but they're not on an electronic exchange. They are with a sort of limit order book. You know, I talked about the buyers and the sellers and the limit order book. It's not that type of market. No, it's a more specialized broker and dealer market. Often they're the same entity. So the major investment banks like JP Morgan, Goldman Sachs, and so forth they're all the bond underwriters, and also they are brokers and dealers as well. But then there are these specialist broker-dealers that historically have been around for ages, like Cantor Fitzgerald. Equities are issued on what we call it as an initial public offering, IPO. Again, it's underwritten by an investment bank. Often the investment bank will give preferential prices to friends, and then when it goes public, the initial public offering, the price is sort of overvalued. That's a standard trick that has been going on for decades with underwriting of IPOs. Anyway, and then when it's traded on exchanges, it is on these electronic limit order book type markets, which are very, very active. So the market capitalization, or market cap for short, is the price per unit times the number of units issued. So if the price of a share is £1 and there are 10,000 shares issued, then the market cap would be £10,000. But actually that's not realistic, because in fact the global market caps of equities and bonds was, global market cap was of equities 127 trillion and bonds was 145 trillion at the end of 2024. And they're both greater than global gross domestic product, GDP. That's all the goods and services produced by the entire world in a year, was just 114 trillion. So yeah, capital markets are very, very important. Bonds have a defined maturity and coupon. Some don't have a coupon, zero coupon bonds, but generally speaking, they have a defined maturity. Well, in other words, it's a 10-year bond, which was, say, issued 6 months ago. So now it's a 9.5-year bond, the remaining residual time to maturity. And the coupon is a regular periodic payment. It's often twice per year. It could be quarterly. It could just be annual, but this periodic payment is called a coupon. And that coupon can either be fixed or floating. So you could have a 5% fixed coupon. So for every bond you hold, which has face value 100, then you would have a coupon of £5, assuming it's a UK bond. Or you could have a floating rate as well. Examples of fixed rate bonds are US Treasury bonds. They have different coupon rates, and gilts. Investment grade company bonds. Investment grade means that it's a credit rating of BBB or higher. And these can have very long terms. I mean, as I mentioned before, US Treasury bonds now go up to 100 years. And then variable coupon or floating coupon typically have interest rate payments linked to the sterling overnight index average. For example, what we call floating rate notes. They have an interest, a coupon payment, which is quoted as a spread over SONIA. So it could be, that's the sterling overnight index average, SONIA. It could be 1% or 100 basis point. Usually we quote these in basis points, not 1%, but 100 basis points over SONIA. But if the issuer's credit rating is pretty low, like BBB or lower, then it might be 200 basis points over SONIA. And also it depends on the maturity as well. So the SONIA, which is just an overnight index average, is compounded to 2 years, 5 years to get the sort of level curve. But then there are zero coupon bonds or discount bonds. And the way they work is that when they're issued, they're not issued at 100. They're issued at 97 or 102 or something like that. Well, less than 100 actually. They'd be, otherwise they'd have a negative yield. So if they were issued at, say, 97, and then in 1 year they were redeemed at 100, then they'd have almost 3% yield. But they tend to be very short-term, these discount bonds, just up to a few months, not 1 year. So bonds are subject to credit risk of the issuer. Even if it's a government, there's credit risk. So that's what we mean by the credit rating. If it's AAA, then the credit risk is very low. If it's triple C or lower, the credit risk is very high. And as I said before, if the company defaults, then the bondholders have a preference claim over the shareholders, the equity holders, for the capital recovered. So equities, a cash equity is a share of a company's common stock, right? Shares have an they don't have a fixed maturity, but they sometimes have payments that they're periodic, maybe, but sometimes they don't happen. And the amount you get depends on how well the company's been doing. That's called the dividend. And some shares, for example, water companies, they haven't been paying dividends for a long time. They're not allowed to, because they've been doing so badly, the water companies in the UK. Yeah, if you hold a share, normally would have a dividend once a year, maybe twice a year. These are subject to market risk, including liquidity risk, as I mentioned before. Now, it's important to understand what the stock market indices are. So that blue link, in fact, any blue link you see in the lecture notes is a hyperlink. And this one takes you to a YouTube video where you learn a bit more about what stock indices are. You can't buy a stock index, well, unless you're a very, very specialist broker. I'll talk about that in a minute. As an individual, no, you can't. You can buy derivatives, or you can buy these things called ETFs, but you can't buy a stock index. So in the US, the Dow Jones Industrial Average is a very old one. That's 30 of the largest US stocks. And the Russell 5000 is another common one. That's got large, small, medium cap company stock in it. And that's got 5,000 different companies. Okay, so let's go on to financial instruments. Financial instruments are a contract that gives rise to a financial asset of one entity and a financial liability of another entity. So a simple example is a loan, right? Now, a loan is an asset to the bank that has perhaps issued the loan, and it's a liability to the person who's taken, or the company that's taken the loan. But these are not directly traded in capital markets, but they can be securitized. For example, you can get things called mortgage-backed securities. We'll talk about those in much detail in topic 2. Now, loans are recorded on a company's balance sheet under assets or liabilities, but derivative instruments do not appear on the balance sheet. A derivative instrument is just a bet, really, on anything that can be measured. For example, it could be a stock price or a stock index price. It could be rainfall, temperature, volatility, anything that you can measure, you can have a bet on. You can have derivatives on football, the outcome of football matches, or elections. So there are 3 broad categories of derivatives. Futures are very common. We've already spoken a little bit to recall, which you've already learnt about futures and forwards. But just to summarize, futures have standard fixed maturity dates, and typically like the 3rd Wednesday of the month. And there's a whole term structure. You could have a futures contract, which is a 1 month or 2 month, 3 month, up to 12 months or so, 24 months, things like that. Forwards are not traded on exchanges, like the Chicago Board Options Exchange, or the CME is the biggest one, the Chicago Mercantile Exchange. forwards are over-the-counter agreements, and they have tend to have a fixed term when two lawyers get together and have a forward agreement, and they might say, okay, this is a 3-month forward agreement or something like that. And options are exchange traded. There are specialized options exchange options exchanges like the CBOE, Chicago Board Options Exchange. And swaps are over the counter. Again, two lawyers get together and decide on all these things. They don't have a market cap because there are always two counterparties, a buyer and a seller. So, but what there is an open interest, the number of contracts where you've got a buyer and a seller matched. And then there are market makers who match the buyers and sellers. And they also have something called a notional amount. So, for instance, for a swap, the notional amount is just some notional amount on which you're going to calculate interest rate payments. There might be a fixed for floating swap. So you have like a notional of $1 billion or of $1 million, and then periodic payments of fixed to floating. So the fixed counterparty pays a fixed rate to the floating counterparty, and the floating counterparty pays a floating rate to the fixed counterparty every 3 months, shall we say. We'll talk more about swaps in topic 2, because that's really a credit risk topic. So finally, we'll notice exchange traded funds and notes. And these can be derivative-like exposures because some ordinary investors, pension funds, for example, are not allowed to invest in derivatives, but they can take on ETFs. And in particular, you could have an active ETF, which isn't just tracking a benchmark. Usually it's some sort of index, a commodity index or a stock index or currency index. Active funds try to outperform their benchmark. They're seeking alpha. The alpha, as opposed to the beta, which is a sensitivity to a stock market index. The alpha is the bit you get above the stock market index, the expected return beyond it. And the way that ETFs work is that people actually replicate with the 100 stocks. If it's the FTSE 100, they will buy 100 stocks in the FTSE, and because it's a market cap weighted index, as soon as the price of any one of these stocks changes, the market cap changes. And so the relative market cap changes for all the stocks. And so you have to continually, constantly, you have to have an algorithm that rebalances. You don't have to really do it in real time, but every so often, the hedge funds or the asset managers that, like Fidelity or Vanguard, that issue these ETFs have to have a replicating portfolio periodically, because there are things called creation and redemption baskets. So to create an ETF is just like a share. You can buy it on the London Stock Exchange. So you can actually buy the S&P 500 index, not on the London Stock Exchange. You can buy it on the New York Stock Exchange. So you can buy the SPDR. That is the name of the S&P 500 exchange traded fund. But the company that issues, or the asset manager, Vanguard or whatever, that issues that share is actually holding a whole portfolio of 100 stocks, if it's the S&P 100, or 500 stocks for the SPDR. The diamond is the ETF for the Dow Jones Industrial Average, and the cubes is the ETF for the NASDAQ, the technology index. And there are other types of ETFs as well, for gold mining stocks, oil companies, things like that. And then you've got very closely associated things called exchange traded notes. They're a bit like ETFs, but they have a finite maturity. So, for example, the London Stock Exchange has just given permission for ETNs on Bitcoin to be traded on the London Stock Exchange, but not ETFs. Again, it's the major asset managers like Fidelity and BlackRock, places like that are. BlackRock's got the main backing of crypto ETNs. These have a finite maturity, say it could be 10 years or something like that. So they're not like shares. And because the issuer is not one of these major asset managers or investment banks, some ETNs have been issued by Credit Suisse, for example, got into trouble. The volatility ETNs that it issued about a decade or more, about 15 years ago, the VXX, TVIX, these were ETNs on volatility indices, so quite derivative-like. There was a big scandal about investors not understanding the risks and lots of lawsuits, which really damaged the company. All right, so that's it for this one. Let's see if I can pull off the next one in a short amount of time. I might have to break it into two. See you there.